Hello, it's Stephen Williams with the Credit Repair Shop. And in today's video, we're going to talk about buying a house because I'm sick of people giving people bad information about credit repair. I'm sick of people telling people how they can buy a house with bad credit or how they can buy a house with a low credit score, and they're setting people up for failure. They're hurting people because they're giving them information that is not true. And I don't know everything about buying houses and all the different programs that are available. I can tell you that I've purchased a number of homes, and I've purchased a few homes where I use my credit, and I can just tell you that it is not the way that you see on some of these videos. I wish some of the mortgage companies would be more open with how they qualify people, but for some reason, I don't know, they're just not. So basically, when you go to buy a house, what they're going to do is that they're going to pull up your credit reports from the three credit reporting agencies. There is no such thing as a mortgage company. No such thing. I guarantee this. No such thing as a mortgage company qualifying you for a house off of one credit report. It is not true. You can call every bank. You can call all the different mortgage companies. If somebody told you that in a YouTube video or some video you saw on Facebook, it is not true. The bureau, all three bureaus, the mortgage company is going to look at all three. And what they're going to do is they're going to average out the number on all three, and they're going to get a score. So let's just say that your average middle score is a 675. Based off of that score, they are going to offer you an interest rate. And let's just say that they offer you an interest rate of 4%. Just for example. Now, you might be saying that, well, I just got my credit repaired by you, Steve, and your score said, and even on my monitoring service, it says that I have a 700 and let's just say 710 and 705. So you got 700, 710, 705 across the board at the top. But when they ran my scores, they said that my average score was 675. So how in the hell did they get a 675 when I'm seeing this up here and I'm calling Steve because I'm upset because your monitoring service that you referred us to, or even my monitoring service that I've always had, said that my scores are this. So why are they seeing this? What they do is they have filters. This is you and your wife and your family. And if you don't believe me, you can call mortgage providers or hopefully someone that you know, and they can explain what filters are. Filters are basically the guidelines and the rules that specific mortgage company puts together. There's guidelines from the federal government, and then they will add on their own guidelines. Now, one thing that I learned from listening to a lady that is where she's actually approved by Fannie Mae, where she can actually get she can say yes to a mortgage through her company without going through any other underwriting process. And she said that the debt to income ratio was lower through her. I don't remember the exact number, but she said it was 41%. Now, this is a big secret on how these companies are making a lot of money off of us. So if the government, whenever a mortgage company gets a loan, they're getting the money basically from the government. They're selling that, and then they are the ones that are the or what's called a servicer on the loan, where they're getting paid interest to collect the money on the loan. So they pay the money back to the government, and they get to keep the interest on the money from what was paid out from the government. And they said that the debt to income ratio is 41% if you get it directly, that they have that on there. But most mortgage companies, what they do is they jump it on their filters. They'll jump it to 45%. So that makes it harder for them. Well, you can get approved, but what it does, it makes it easier for them to jack up that interest rate. So now we might be looking at 5, or let's just say 4.75, somewhere right there. And they're justified because their filters get them to that. Now, what is the filter? What do you mean, Steve? What is the filter? You're saying filter. Explain it to me. The filter could be if you're single, has nothing to do with your credit. What it has to do with is your situation, who you are as a person. It could be if you're single with kids. It could be if you're married. How long you been married? How long did you live at your previous residence? And on that application where they always say, have you lived there for 2 years? Do you think that they just came up with that out of thin air? Well, yes, they did come up with it out of thin air, but it's became a standard with the way that they qualify people. So now you know they put that on there to filter you. So now if you lived at your residence for less than 2 years, they can pull your score down according to their standards. Let's say that you have 4 credit cards and your credit card balances are high. They can lower your credit score according to their filters. So now do you get the picture? So now you may be asking me, how do we know the filters? We don't know the filters because the companies do not have to disclose the filters. So then what happens if you get to going around and you having all of these companies running your credit because you don't know what their filters are? And another filter is also time at the same job. Just wanted to throw that one in there. So you go around and you're trying to get the best interest rate, and all of these damn companies are dinging up your credit because you're going out there, because you're seeing that you're not getting the rate that you think you deserve, and it's solely because of the filters. So now that you know this information, let me tell you how you go about fighting. But before we get to that, we're going to talk about how you can fight it. We'll talk about that in a second. So now, but let's get back into buying a house. So now, let's just say that you get qualified. They offered you a 4% interest rate. So the next thing that they're going to start to do is they're going to start looking at your debt to income. So we already talked about that. So they're looking at your debt to income ratio. If you fall under their percentage with their filters, they can deny you. They'll deny you for the loan. If you fall below on your debt to income ratio, how can you fix that? Ask them what percentage you need. First, ask them how they're figuring your debt to income ratio. I've learned that companies do it a little bit different. Sometimes student loans count more against you, sometimes they don't. So ask them how they're figuring the debt to income ratio, and then look at what you can do with adjusting. Sometimes it's simply paying off a credit card or lowering the balances across the board on credit cards. Sometimes it's paying off a card and closing that card. So once you find out where you need to be with the debt to income ratio, then that's fine. Now the other thing, which is what we run into a lot when people do credit repairs, that they don't understand this, is that you need to have everything resolved on your reports, and you need to have everything resolved with public records. That's very important, because what they're going to do is they're going to run what's called a title search on your name. And anything that pops up with public records, they're going to question you about it and say that, is this your debt? You know, is this an old account that you had that may be a judgment or something? You're going to have to take care of that, or you will get denied. On your credit reports, when they look at your credit reports, if you have any collections that are on there that are not resolved, they're going to deny you. Now, something that a lot of people don't know, and that's why I'm making this video, is that people get too focused on what's on their report. Even if it is resolved, they get too focused on that information rather than having everything resolved on the report so they can get approved for the loan. So if you have everything resolved on your reports, even if it's not deleted, it's just showing that it's resolved, and then you have resolved everything that you have on your public records, because they're going to run a public record search on your name. If that stuff is resolved, it does not have to be removed off the system. It just has to be resolved. You're going to be in good standing to get approved. Now, how do you fight back when it goes to you getting denied? Is that when you know what your credit score is, and you so let's, for my example, you had a 700, 710, and 705. You contact your mortgage broker. When they come back and they tell you that, well, they're figuring your score on, your numbers are coming up different in their system. And something that I found is that a lot of mortgage people don't even know that their systems are using a filter in there. They would have to get to one of the upper management or one of the underwriters to be able to know exactly why your score is reflecting lower. But you get with them and you tell them that you know where your scores are, you know that all of this stuff is resolved, and that you think that you are not getting a fair shake at getting the best interest rate or getting approved. And then if you can have them do a full review of your application to make sure everything is matching, and give you a solid reason on why you were denied for the loan. You need to do that every time. Something that I've found when dealing with car dealers, this is a little bit off the subject, but car dealers will use one of the 3 bureaus to approve you, but you can show them if they have filters, because they're sending them to banks, and the information that's on your report is sent to banks, and they're going to filter it according to what they want to make the loan for. You can fight with them and say, I see what my score is. And one thing that they are able to do with auto loans is that they are able to fight with the banks and say that on your reports is showing a higher score than what they're reflecting when they go through their filters. And I've seen where they will make interest rate adjustments just off of that. And so I hope that this is helping you get a lot clearer, so you can get into that house and have your nice car with your family, because one of the best ways to build wealth is through your home. You're going to have to pay somebody to live somewhere. Why not pay and build wealth for yourself? So again, my name is Stephen Williams with thecreditrepairshop.com. If you need any help, just click our website and submit your information, and we'll give you a call back. Or you can look through the website, and if you would like to sign up with our services, we would like to help you and help you get your goals accomplished. Until next time, thank you.